Nesi Chetty is Fund Manager and Head of Property at Momentum Asset Management. He's with us now to look at South Africa's commercial property market. Morning, Nesi. Let's just give us an overview first, 2014 and the various sectors that you guys look at.
Thanks, David. Yeah, 2014 was quite a phenomenal year for the listed property sector. So the market went up some 27%. The preceding two periods, 2012 was also good, up some 30. 2013 was a bit soft. But if you look at listed property performance, I mean, if you break that down into the individual segments, industrial was the best performing unit last year, up some 20-odd%. Then retail at about 16%, and then office maybe a bit of a disappointment, coming in at about 11 or 12%.
How does that all add up to 27?
Yeah, look, I mean, I think that there's two things you got to look at. Is, I mean, that's an IPD number, so that's the direct property market, and then you also got to look at what the listed sectors are doing. Now, the listed sectors have the benefit is that they can gear up a lot more easily. There's a lot more liquidity in the listed sector versus the direct property market. So what you've had the last couple of years, and even so the last 5 or 6 years, is that the IPD direct property market has been lower than the listed sector. And listed's been very good for two reasons: because of the lower bond yields. Bond yields all the way from March last year went down another %. And you also had very strong fundamentals. So distribution growth, which investors like, was up 9.5%.
Nesi, so should I be investing in property at the moment?
Look, I mean, the advice to investors is that from property you get the benefits of, one, it's a stable income yield. So if you look at listed property over the last 10 years, the income yield has been around 6 or 7%. I think if you're an investor in a balanced fund or want exposure to new asset class, the nice thing about listed property is that it gives you the benefit of diversification. Versus equities and versus bonds as well. I mean, it's negatively correlated to cash, and the correlation to equities is quite low. The nice thing about listed properties is if you have an exogenous shock and a lot of volatility in equities, is that property doesn't suffer the same drawdown. So if you look at the over a 20-year period, there, even in 1998, when you had the Asian crisis, and you look at the financial crisis in 2008, property didn't go down 20% or 30% in typically what you'd expect from equities. I mean, it was down about minus 3 or 4%. So as a property investor, you have the outlook is quite good in that you're getting real returns on this asset class. The other thing about property versus direct market, if you're a small investor and if you want access to the residential property or commercial or the retail space, the amount of money that you have to outlay could run into the billions. As a nimble investor that wants to play maybe a high prop with a canal walk or a growth point with the waterfront, you can invest in these funds and get very good yields and good access and exposure.
You mentioned the IPD, and I recall an IPD conference of a few years ago where it was remarked that there was very little investment or interest in residential property, as in there was commercial, office, industrial, but not residential. Now that seems to have changed, but I'd be interested to know exactly how it's changed, because you don't buy individual houses, you can factories in industrial. So is it whole cluster estates that we're talking about here, that kind of investment?
Look, I mean, the difference between residential in the direct property market and the listed property, I mean, there's a vast difference. So when you talk about the direct, it's predominantly residential. So it's the likes of an Abland that's doing residential or a Zenprop. In the listed space, when we talk about residential, it's mostly student accommodation. So if you look at the two big listed companies, Octodec and Premium, used to have quite a bit of dominance in that student accommodation space. What you saw last year is other listed companies like SA Corporate trying to tap that residential market. And this is accommodation in areas like Hillbrow, Yeovil, other parts of Joburg where you're getting good escalation growths and vacancies are quite low. SA Corporate were quite fortunate that last year they did a 1.5 billion transaction. The thing with the residential supply is that there's probably only 300 or 400 million that can come onto the market each year. Realistically, the market isn't big enough to do a 2 billion or 3 billion deal each year. We've got a slightly positive view on residential. We think over the next maybe 10 years, there could potentially be between 5 and 10 billion of that residential that comes into the market. And the companies you can play that through is Octodec, Premium, and bits of SA Corporate.
Nesi, what about the European market? We're seeing the likes of European property or EPI, however way you want to pronounce it, and also you've got retailers like Foschini investing in Phase 8 for the retail space. So is this an area of growth if I'm thinking of diversifying my property portfolio?
Yeah, so certainly, I mean, within the South African property market, I mean, the way you can play those retail themes offshore is through companies like Into, which is the old Liberty Properties, Nepi, which is a Romanian-based company, has very good retail properties in Eastern Europe. More recently, I mean, a company like Redefine did a large transaction where they acquired 58 properties in Western Germany in a joint venture at an amount of 160 million euros. So what you're finding in the Eastern European market and parts of Germany and the UK is that, one, retail sales is starting to recover. So you're getting the like-for-like improving there. Vacancies are quite low. And the consumer is also in a position of relative strength versus the prior year. So they're still benefiting from a low inflation, low interest rate environment. The one thing I would caution is that, I mean, if you look at the yields, SA retail versus offshore, I mean, you can buy a company like Hyprop, which owns Canal Walk and Rosebank. I mean, you get them on a yield of just under 5%. 2 or 3 years ago, they were on yields of 7.5%. So that entire market, the yields have come down. European retail tends to trade at 3 and 4%. So you sacrifice a bit of yield, but you get stable growth in retail. And it's one of the sectors we think will continue to do well this year.
Thanks to Nesi Chetty. He is fund manager and head of property at Momentum Asset Management.